The global economy is teetering on the brink of a recession, and the blame lies squarely with President Trump's reckless trade war. Economists are sounding the alarm, with Goldman Sachs increasing the probability of a recession in the United States to a staggering 35%. Moody's, another leading financial institution, paints an even bleaker picture, putting the odds of a downturn at a worrisome 40%. These figures represent a significant jump from previous estimates, reflecting the escalating trade tensions and their corrosive impact on global markets. The specter of recession is particularly troubling given the current state of the U.S. economy, which has been enjoying a period of sustained growth. However, this hard-won prosperity is now under threat as businesses and consumers alike grapple with the uncertainty unleashed by the trade war. The stock market, a barometer of investor confidence, has reacted with predictable negativity, with major indices experiencing their worst monthly losses in recent memory. The Dow Jones Industrial Average, the S&P 500, and the tech-heavy Nasdaq have all tumbled into correction territory, wiping out trillions of dollars in shareholder wealth. Adding to the sense of unease is a precipitous drop in consumer confidence. The University of Michigan's Consumer Sentiment Index, a closely watched gauge of consumer attitudes, has plunged to its lowest level since the dark days of the Great Recession. This decline in confidence is being driven by a toxic cocktail of factors, including rising prices, stagnant wages, and growing fears about the future. When consumers are anxious about the economy, they tend to rein in their spending, which can further depress economic activity. The trade war is also putting upward pressure on inflation, which erodes the purchasing power of consumers and businesses. The Federal Reserve's preferred measure of inflation, the Core Personal Consumption Expenditures (PCE) price index, has already climbed above the central bank's 2% target. This acceleration in inflation is being fueled by the tariffs, which have raised the cost of imported goods, forcing businesses to pass those costs along to consumers in the form of higher prices. This inflationary spiral is further eroding consumer confidence and squeezing household budgets. At the heart of this economic turmoil lies President Trump's decision to impose sweeping tariffs on goods imported from China and other trading partners. The president's rationale for these tariffs is that they are necessary to protect American jobs and industries from unfair foreign competition. However, economists warn that the tariffs are actually hurting the U.S. economy by raising prices for consumers, disrupting supply chains, and creating uncertainty for businesses. The president's latest salvo in the trade war is a plan to impose new tariffs on all nations by April 2, 2025. Goldman Sachs, which has been closely tracking the trade dispute, estimates that these new tariffs could average 15%, with reciprocal tariffs from other countries likely to follow. This escalation in protectionism is expected to further dampen global economic growth and increase the likelihood of a recession. The tariffs are already having a tangible impact on the U.S. economy. Farmers, who rely heavily on exports to China, have been hit particularly hard by the trade war. The tariffs have made American agricultural products more expensive for Chinese buyers, leading to a sharp decline in exports. This has forced many farmers to accept lower prices for their crops, putting a strain on their finances. Some farmers have even been forced to declare bankruptcy. Manufacturers are also feeling the pinch from the tariffs. The tariffs have increased the cost of imported components, making it more expensive for American manufacturers to produce goods. This has led to higher prices for consumers and reduced profits for businesses. In some cases, manufacturers have been forced to relocate production overseas to avoid the tariffs, resulting in job losses in the United States. The economic outlook for the United States and the rest of the world has darkened considerably in recent months, as the trade war continues to escalate. Goldman Sachs, in its latest economic forecast, has slashed its growth projections for the U.S. economy. The investment bank now expects the U.S. economy to grow by just 1% in 2025, down from its previous forecast of 2.5%. This would mark a significant slowdown from the 2.9% growth rate recorded in 2024. The slowdown in economic growth is expected to have a ripple effect throughout the economy, leading to job losses and lower wages. Goldman Sachs predicts that the unemployment rate could climb to 4.5% by the end of 2025, up from its current level of 4.2%. This would be the highest unemployment rate since 2017. The bank also expects inflation to remain elevated, forecasting that core PCE inflation will reach 3.5% by the end of the year. These grim economic forecasts are a reflection of the deep uncertainty and anxiety that the trade war has injected into the global economy. Businesses are reluctant to invest and hire when they are unsure about the future direction of trade policy. Consumers are also pulling back on spending as they grapple with rising prices and stagnant wages. This decline in business and consumer confidence is a major drag on economic growth. The trade war is also having a negative impact on global supply chains, which have become increasingly integrated in recent decades. The tariffs are disrupting the flow of goods and services across borders, leading to delays and higher costs for businesses. This disruption is further weighing on global economic growth and contributing to the rise in inflation. The economic fallout from President Trump's trade war is not confined to the United States. The tariffs are having a ripple effect throughout the global economy, as countries retaliate with tariffs of their own. This tit-for-tat escalation in protectionism is threatening to derail global economic growth and push the world into recession. Global stock markets have been hammered by the trade war as investors flee to safety. The MSCI All-Country World Index, which tracks stocks in 47 countries, has plunged into bear market territory, falling more than 20% from its recent peak. This sell-off has erased trillions of dollars in wealth and raised fears of a global financial crisis. The trade war is also putting a strain on relations between the United States and its trading partners. China, the European Union, Canada, and Mexico have all retaliated against U.S. tariffs with tariffs of their own. This escalation in protectionism is threatening to unravel decades of progress toward freer trade and globalization. In response to the growing economic turmoil, central banks around the world are taking steps to shore up their economies. The Federal Reserve is widely expected to cut interest rates multiple times in 2025 in an effort to stimulate economic growth. The European Central Bank and the Bank of Japan are also considering further easing of monetary policy. However, monetary policy alone may not be enough to offset the negative impact of the trade war. Fiscal policy, in the form of increased government spending or tax cuts, may also be needed to boost economic growth and create jobs. In addition, a resolution to the trade war is essential to restoring business and consumer confidence. While the economic outlook remains uncertain, there is a glimmer of hope that a resolution to the trade war may be possible. President Trump and Chinese President Xi Jinping are scheduled to meet at the G20 summit in June. This meeting will be an opportunity for the two leaders to de-escalate tensions and find a way to end the trade war. However, even if a trade deal is reached, it will take time for the global economy to recover from the damage that has been done.